everyone. Happy Monday, or at least Monday. It is March 13th. I'm Dave Keller here at StockCharts.com. In the final bar, we're going to talk about this market environment, particularly the weakness, this contagion potentially continuing on as certain risk assets rally just fine into the close. Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we try desperately to make sense of these markets in uncertain times using the toolkit of the technical analyst. Price and an analysis of price, I would argue, gives you an insight, a window into the thinking of millions of investors making their buy and sell decisions. All of those decisions and those emotional reactions or overreactions to the environment are what create the price movements that we can then analyze over time. And the technical toolkit has been demonstrated to really help investors understand that market and use the benefits of what's called momentum investing or trend following to bet on long-term trends that tend to persist. Now, currently, we are experiencing some unusual times for sure, and just the headlines I feel like are evolving hour to hour, if not minute to minute, at times over the last 72 hours or so. I was actually down in San Francisco over the weekend, and thanks again to Aaron Swenlin from Decision Point for hosting this show beautifully on Friday for me as I was out. But had a lot of conversations with people on the ground in San Francisco about what Silicon Valley Bank and the developments there means, the chances of a broader contagion, how to think about risk versus reward in an environment like that. We're going to get to a series of charts that hopefully help you answer those questions for yourself. And let's get right to our market recap. So an interesting day. And at the end of the day, quite a bit of choppiness while the end of last week was certainly deteriorating very, very quickly. It was sort of like what the market needed the most was just to get to the weekend and sort of put a period on last week's trading. Today, we opened up and again, had quite a bit of movement. What's interesting is the S&P just finished about 0.15% below the close. And you'll notice on some of the charts, by the way, on StockCharts, a little glitchy data. We had an issue with our data vendor today, going through the process and tweaking and correcting it. So the current values should all be completely fine. We're just sort of backfilling some of the intraday data as we can. But just in case you see some weird behavior on the show, that's all that's going on. We'll get to it, and our data team's working on it for sure. But the S&P in the end finishing just a little bit in the red below zero. The Dow leading the way lower, and the Nasdaq actually finishing higher. So it's interesting. The questions going into today, with the Silicon Valley Bank essentially going under, with the government stepping in to bail them out or at least support the depositors. What next, right? Is this the part of something bigger? And if you look at the stocks that were down big today, obviously a lot of regional banks. FRC was another California-based bank, which was halted. CMA, you have Comerica, Key, Zion Bank, Huntington, Fifth Third. A lot of these are Midwest banks, but most of them down double digits in sort of complement with or in sympathy with some of the big gaps lower that we saw. There's no denying that happened. But what's interesting is if you look just to the left, there are plenty of stocks that are up. And when I think on a day like today and on a week like we've had, what differentiates a steep sell-off with limited exposure, limited areas of the market feeling that pain versus something broader and more destructive? When half of the S&P sectors actually finish in the green, which is how I would describe today, it's hard to think of this as a broad risk-off move telling you the S&P is definitely going to 3,200. What it tells you right now is certainly banks are struggling and the financial sector very much difficult. We'll look at a series of charts that sort of make that case here in a few moments through the course of the show. But REITs were up 1.6%, utilities up 1.5%, healthcare, technology, consumer staples, all finishing at least 0.5% above Friday's close. So those are fairly defensive sectors, generally speaking. And the parts of tech that were really working were some of the, blue chippy parts like Microsoft and others. But overall, not horrible. Now, the reason is, and I guess the other things that are going on are just the, all the interplay of the different asset classes. So if we could, let's look at some of the different charts and see what actually played out here. Just briefly to talk about the movements that we saw today. Interest rates overall, kind of a really fascinating day. Bonds pushed higher through the course of the day. The yield curve in general moved lower, and you can see across the curve, rates are coming down. And what that basically is the market now pricing in a 25 basis point cut at next week's Fed meeting instead of a 50 basis point cut. A week ago, last Monday, it was very clearly favoring a 50 basis point cut. That certainly seemed most logical to me based on where the market was headed and expectations based on language from the Fed. Now it's a lot of assumptions and a lot of guesswork based on the headline risk and based on comments that we've heard from government officials, but overall seems more likely about a 25 basis point rate hike. As a result, bonds are rallying pretty good, the dollar coming down, and that's what's allowing risk assets to actually move higher a little bit. Commodities quite a bit mixed, but particularly gold moving higher, silver as well. We'll look at a chart of gold here in a minute, and cryptocurrencies bouncing very, very nicely. Now, of course, cryptocurrencies with a little more exposure than the average random, U.S. listed stock because of, direct or indirect ties to some of the banks that have been called into question or have now, failed here in the last couple of days. So understandable risk in crypto land. However, the idea that the government's coming in to bail things out and to guarantee deposits certainly implying more stability than you might have initially expected. So cryptocurrency is actually moving to the upside very quickly here, going into the equity close. Let's look at some of the charts that put a little more detail behind some of those comments that I just said. Here's a chart of the S&P 500. You can see, as I mentioned, finishing the day not too far below where we started or where we ended the day on Friday. We actually gapped down a little bit at the open, traded down really essentially to the December lows. Now on Friday, I know Aaron Swenlin was doing the show here as I was analyzing the charts and sharing some comments with my market misbehavior premium members. We focused on this December low. This is the green shaded area that I now have updated on the chart here. We're at the upper end of that support range. That 38.10, 38.15 level, that's a support level we've been talking about for quite some time, right? As the market was topping out in early 2022 and rolling over, we started to identify some potential downside targets for the S&P, and 3,800 was really the first really significant one because that's a 38.2% retracement of the March 2020 low to the January 2022 high. So fascinating to me with everything that has happened from that moment, right? When we first started talking about over a year ago, start talking about that 3,800 level. Today, as we gap down on the open and trade a little bit lower, we literally get right back to that same level and push higher. This is why Fibonacci retracements are often on my charts, because I've found this more often than not. Levels that have meaning at some point just tend to come back, and you can look back and see how that makes sense from a technical perspective, just looking at, classic analysis of support and resistance. So not surprising that the December low was right around the same level, around 3,800, and now we're once again testing it. So I would say, broadly speaking, from a technical perspective, there are one of two things that can happen. It's clear to me that the market's more in distribution mode overall. And I would say that by the fact that we made a lower high in early March, and then we broke below the 200-day moving average. We closed below it on Thursday. And my question on Thursday's show, do we have a follow through to the downside? We absolutely did on Friday, right? We sort of pushed much, much more lower to around 38.55, 38.60. Today, however, we trade a bit lower and trade down to that support. So that green shaded area is sort of the lower end of a reasonable expectation of where we're at. If you look back at the last 4 months, this is kind of the range that we can loosely define, right? From around 3750, 3800 up to 4000, 4100 as the upper end. One of two things is going to happen. We either fail to hold support and blow through, call it 3,800 to the downside, which I think opens the way to this purple shaded area down around 3,600. That would essentially be a retest of the September-October low and also the June low of last year, or we find support here. So I think while things have come down, very abruptly, the fact that at this point it's more localized in the financial sector and less feeling it in other parts of the equity space, suggests to me there's a non-zero probability that we start to find a flow here. Now, I'm a trend follower, and I would say the trend overall seems negative to me. So I'm going to assume that the more likely scenario is we actually fail to hold the support, that the implications of what we've learned over the last couple of days are not really understood or felt yet. and we're just a bad headline or two away from, a pretty good breakdown. So I'm focused more on risk, and that's what I'm suggesting to people is make sure that stop levels are updated. Make sure you clearly define your exposure, your risk versus reward, and make sure you think about the bets that you're taking. What's so interesting though, right, is if you look at the XLF, if you look at the KRE or the KBE, which are the regional bank and the bank ETFs, they've obviously come down quite a bit. Pretty much everything I just said is oversold. Again, meaning from the traditional technical perspective, it's gone too low too quick. Now, becoming oversold usually doesn't mean it's the end of that move. It just means you're now looking for the turn higher, right? We're now going down in a significant way. When we're out of that oversold region is when things start to potentially look encouraging. What's interesting to me on the chart of the XLF is we're pretty much really, really close to the June lows of last year and the September-October lows. While the S&P actually made a new low in October, as did the NASDAQ, the financial sector actually had a fairly stable support level right around 30 for the XLF. We're not too far above that level. So I think we're getting to that point where financials could actually be finding support. Remember the 2008 low, 2009 low, and again, not comparing right now to the financial crisis as a one-to-one analog, but just saying there's certainly some similarities with an actual bank failure and thinking about what happened. Remember, financials had sort of the most V-bottom of all the V-bottoms. They came out of that low. They led the way lower, but also recovered most quickly. The first couple months after the '09 low, banks were actually fantastic. Then they sort of stabilized while everything else started to catch up. So I think looking at the chart of the XLF in this environment could be really, really important just to see how things play out. Now, I do want to just touch on a couple. I feel like we could have an hour show just trying to debrief on what's happening, but we will limit it to the time we have, and we'll do it again tomorrow. But I did want to point out on volatility, right? We talked about this range on the VIX loosely between 20 and 30, and often undercutting 20 a little bit, overshooting 30 a little bit over the last year and a half. If you can look, we, of course, once again, we're just below 20 early in March. In the last week, we've spiked up aggressively, right? As uncertainty has exploded, as fear has been more rampant, volatility goes higher as the volatility in the S&P options market is increasing. We are now up right at 30. And during the day, we actually pushed above 30 for the first time since October of last year. So this is pretty significant, I would argue. Now, if you look back, a lot of the major bottoms in 2022 happened with the VIX not too far above current levels. Now, we came off a bit, and the VIX ended up about 7% above yesterday. Ended the day around 2650, just below 27, but got up to almost 31 today. So I think watching to see if there's further volatility, that chart of the VIX could be a really interesting chart to watch as well. I'm watching the financials to see if they are able to find a bottom and see if the VIX is able to get above 30. And if so, that's where I would start to look for at least some sort of short-term stability in the markets. Just to finish off briefly on our market recap, we have to talk about fixed income. The TLT, if you look, facing resistance, look at the December high, look at the February high, and look at where we had an intraday high today, right about the same level. Now, the difference is the TLT now trading above its 200-day moving average. It actually closed right back at its 200-day. So I can't say that was a valid break of the 200-day just yet. The last time we broke above the 200-day was there in early February. We ended up coming right back down. So that's probably the third chart I would be watching very closely is see if the TLT is able to find resistance right about at the intraday high today. We trade much above that. That tells you lower rates and that this could be more of an exaggerated move than we might have expected. Just before we go to the break, I want to make one brief comment. We actually lost one of the giants in technical analysis in the last week. Steve Leuthold was a longtime technical analyst based in Minnesota. There's actually a whole Minnesota group of technical analysts, which you may or may not be aware of. You probably know some of them because they've come on my show. Steve actually got his start in a number of years ago at Cargill, where he traded commodities, a big firm in Minneapolis, private company, then went and studied, got his start on Wall Street at Paine Webber. He then went to Piper Jaffray and Hopwood, which became Piper Jaffray, which became Piper Sandler. And that is where people like Jeff Hughes, Craig Johnson, both of which have come on my show, Ed Nikoski, who is a longtime technical analyst, all sort of collaborated with Steve at Piper Jaffray. Steve started the Leuthold Group in 1981. It was one of the first independent institutional research firms, which is a common practice now, but was actually very unique back at the time that he launched it. They published a green book every week, which I remember getting in my Fidelity days, and I absolutely loved reading it. He won the CMT Lifetime Achievement Award, which puts him in a relatively small group of people that have done an incredible job with their career to further technical analysis and to tell the great stories of analyzing price. So rest in peace, Steve Leuthold. We'll be back after the break. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close. Excited to tell you tomorrow at this time, we'll be broadcasting from our brand new studio. That's our plan. I hope it works out, and I think it will. And we'll look forward to making the show awesomer over time, as we hopefully have done from the start to where we're at now. A couple quick announcements before we continue on. We welcome your feedback, but particularly we welcome your questions. We're going to do a mailbag segment here in a few moments. These feature questions asked by people like you over the last couple of days. You can email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to hear from you and answer your question live on the air on Friday's show. Upcoming guests, Wednesday, March 15th, we have Ryan Dietrich. He's the Chief Market Strategist at Carson Group, one of the best at really telling the stories of market history and applying them to what we're seeing now. Very keen on getting his take, given the uncertainty that we've seen here in the last week or so. Miss Schneider of Market Gauge, a frequent guest, will be joining us again on Thursday, March 16th. She had her background in agriculture, really focuses on the commodity space. Some nice bounces this week so far in commodities, so we'll see what she thinks about that space and elsewhere. Let's continue on our show today with the Final Bar mailbag. Please keep your great questions coming, and let's get to question number one. For the S&P 500, Dave, is your base case a meandering ABC correction with wave A, 48.18 to 34.91, a big wave B, 34.91 to somewhere, and then a wave C, which would be a big drop, generally speaking, equal to wave A. So let me explain that question. If everything you just read and heard does not make sense, I will tell you what that question is actually getting to. And it's really more the broader wave structure of the market. So I'm actually going to go to a weekly chart of the S&P. We bring up the market trend model, right? So if you think about it, what he's basically saying here, and actually let's bring up SPX. So if you look at the peak in January of 2022, it's around 48.18. And the question is this a big A wave down to here, down to the October lows? Then we're in a big B wave, and then we have a big C wave. And if that's true, Elliott Wave methodology would say waves A and C in a three-wave correction tend to be equal, which means if you do the math and just do the lines on the chart, we're going down pretty far, right? That would have to be a measurement down around like 2,800 to 3,000 or so. So is that my base case? No. And you probably know if you have watched the show for a while, I'm not a big Elliottician on my own. People like Jeff Hughes, who I mentioned when I was talking about Steve Leuthold's unfortunate passing. Jeff worked with Steve for a number of years and actually shared a lot of the details I was able to share with you there. So thanks again, Jeff, for that. Jeff is an Elliott Wave analyst and uses that as one of his inputs. So I'll check in with those guys, see if I can bring someone like him on the show soon and see what he thinks about your question. But overall, I'm more concerned with the trajectory in trend, right? And I'm more of a trend follower. I'm less concerned with where the measurement based on a wave count may exhaust. And I'm more focused on the trend and how we get from here to there. And I'd rather use things like moving averages, trend lines, retracements, momentum indicators like RSI to gauge that. But that's where talking with someone like an Elliott Wave analyst can be helpful to see how it relates. I get the argument. I'm just not convinced that wave structure is going to be so orderly and that we've established a wave B already. I don't think we're sort of there yet. Next question. What's your take on gold? I see GLD in a downtrend, but seems like it should do well in a market downtrend. And fair disclosure, you actually sent in your question before this bigger. I sent it in before Friday's show. I shared it with Erin Swanley. She wasn't able to get to it on the mailbag on Friday, so I wanted to make sure I got to it. Gold, of course, has rallied. We've been talking with our premium members of Market Misbehavior about the upside potential for gold. It hasn't worked particularly well, right? I think about gold as a safe haven. And I was doing an interview last week for the Financial Sense podcast hosted by Jim Puplava, and he asked me about gold and sort of talk about what happened with gold as a safe haven. The dollar's been so strong over the last 12 to 15 months. It's kind of killed gold in a lot of ways as usually a brilliant way to hedge inflationary risk. However, the fact that we pulled back in February and then started to find a floor around 168 for the GLD, I think it's kind of encouraging. So the bounce we saw on Friday told me certainly some upside potential here, and we certainly are following through to the upside. I think gold actually could be a decent place to be given the uncertainty. And again, while it feels like things are limited right now with the downside risk for equities, Yeah, I don't think that's a clearly defined limitation just yet, right? This could become bigger. And if so, you go to safe havens like gold, and I think it actually could materialize a little better than it has been historically. On the GLD, by the way, 180, 181 is a really important level to watch. I'd love to see if we could get above there. That's pretty much in line with the highs that we saw in 2022 as well. Next question, what does your toolkit say about Bitcoin here? Do you have a price target? I actually did an interview earlier today with CNBC, and we were talking about Bitcoin. I was asked about the long-term versus short-term. And here's what I'll tell you. Here's my chart of Bitcoin, just to show you where we're at. I think the challenge for Bitcoin is that, of course, there's instability in the system, particularly banks tied, directly or indirectly to cryptocurrencies. That definitely puts a question mark on the stability of something like a Bitcoin or Ethereum or something like that. You're seeing this rally here over the weekend into today because, of course, government stepping in and providing a little more stability than you might expect as a result certainly shows this could be short covering as well when you see a sudden move like this, causing things to go higher very, very quickly. What's interesting about the chart of Bitcoin now is if you separate that short-term rally, which is sort of a risk-on, things are okay type of rally, think about the longer-term structure. And I would argue you're sort of range-bound right now between 25,000 on the upper end, which was the peak from mid-February. That was the end of that bearish momentum divergence we've talked about on the show. And then about a week ago, we bottomed out right at the 200-day moving average, which was also right at 20,000, which is a big round number. And big round numbers have often been really important on the chart of Bitcoin. And you don't have to believe me, just look back on the chart over the last couple of years, look at how many times we've hit one of those big 10,000 round numbers and have turned very quickly, or at least it's been an important pivot point for the chart. Right now, I would argue we're sort of between 25,000 on the upper end and between 20,000, a little maybe below that on the lower end. One of those levels is going to break as this consolidation phase ends, and I think that will be the question. I'm concerned about the downside on a chart like Bitcoin, given the uncertainty and given the possibility that risk assets maybe are bouncing as a short-term reaction and not recognizing the longer-term headwinds embedded still in the Fed and their plans to raise rates. Still an open question. So for now, I'm looking at that 25,000 level. Break above there, I think, makes this a little more constructive than it's been so far. Next question, has the percent above the 200-day moving average indicator moved back below 50 so quickly in previous bull markets? I love that question so much. And what you're asking about, you can go to the Mindful Investor Live chart list. We'll go right to this guy. And I'm going to bring up the chart here just so we can mess around with the dates. So the question was, we sort of sound the all clear of sorts, right, in November of last year when this indicator, which is the percent of S&P stocks above their 200-day, had been below 50% for quite some time. That horizontal line is my line helping me just visually see, is this overall bullish, meaning above 50, or bearish below 50? And breaking back above 50%, holding that in December is all part of that bullish case that I think really emerged in the fourth quarter of last year. If you look at what's happened now, though, in the last week, it's gone back below there. Percent above their 50-day, all the way down to below 20%, even after today's sort of settling in after the sort of risk-on rally today. So what does that mean overall? You were asking about deeper history. What's beautiful about chart analysis is you don't have to guess. You can actually look back. Someone once told me that charts are the truth serum for the markets. That was one of my old Fidelity analysts used to love saying that. And the comment was like, you don't have to guess about what works or what doesn't, what tends to work, what tends to struggle, what tends to be good. You can look at the chart and actually see what has happened. And your question was, has this happened a lot where it's actually turned in, from negative to positive and then gone back below so quickly? So the answer is not often, and certainly not since the financial crisis. If you look back in the last 10 years, you can see, for example, all clear here in fourth quarter of 2015, we very quickly came down. But I would argue we never really spent a lot of time above that 50% level. Here we've been above it for 4 or 5 months. So that's a little bit different, right? You can see we also happened here. We broke above. We never really went below there. We spiked above it in the second quarter of 2020, but then very quickly came back below it. So have we seen a look just like this in a while? Certainly not. And so that's what's sort of an interesting differentiator. It's hard to look at a lot of historical examples of this happening because we just haven't seen it in quite some time. I'm going to do a deeper dive in this, by the way. It inspired me to think about some other phases, particularly if this is a broader rotation from a bullish phase to a bearish phase? Can we draw some parallels between what we're seeing now and maybe some other historical longer-term topping patterns? I did not go through some of that deep history, and you've inspired me to dig in there a little bit more. So thanks for that question. That's my initial take on it, and I'll probably try to dig into that a little bit deeper this week. That's it for the mailbag, folks. We have to go right to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Someone asked me about the relative strength in small caps, and I've talked with a number of my guests recently. I think it was Mike Siccardi last week. We talked about small caps and their performance, what that tends to imply. Certainly, there have been times in the last couple of years where the market has rallied without small caps leading it. I'm thinking particularly coming out of sort of that 2020 low. You had that period, I think in 2021, where FANG stocks were sort of the juice. They were leading the market higher, and small caps were actually lagging, even though the market was doing just fine, right? It was just a mega cap-led rally. That's not been the case here. And if you look at the last 12 months, small caps have been outperforming large caps. And the top half of this chart is the IWM, the Russell 2000 ETF versus the SPY, the large cap index ETF. So this line is going up, small's outperforming large. The line's going down, which it certainly has so far in March. Small caps underperforming large caps. So the question was, is this a big sell signal that small caps are underperforming? I think what you have to remember is when you're looking at large caps and mid caps and small caps, you can't just think of it as, are people buying big companies or small companies? Because that's not all you're looking at. What you have to remember, anytime you're looking at an index or an ETF, there are a number of different dynamics that you're actually looking at. You're looking at value versus growth. You're looking at sector concentrations and so forth. So our large cap benchmarks are very growth oriented, meaning technology, consumer discretionary, communication services are pretty big weights in the S&P 500. You look at the Russell 2000, it's a lot more things like financials, which are a much bigger place. All those regional banks usually aren't big enough to make it in the S&P, but a lot of the smaller ones are in the mid cap or small cap indexes. So when you're looking at the Russell 2000, you're sort of getting a good look at the companies that are probably much more likely to be feeling the pain of what we've seen over the last couple of days with Silicon Valley Bank and others, going under, and just the pressure on regional banks there. So the ratio at the bottom is showing the KRE, the regional bank ETF, versus the KBE, which is more of the larger mega cap bank ETF. See how that ratio has been going down for quite some time, but accelerated to the downside. The exposure of the smaller banks is what's really really feeling the pain right now. I think that's what small over large going down is telling you more than the fact that, people are going risk off, and rotating to larger names. I think it's more of a sector thing we're seeing for now. Chart number 2, by the way, is the 10-year interest rate $TNX. In our market recap, we looked at the TLT, which is a long bond ETF. We talked about it bumping up against resistance. Kind of flip that chart over and you get a chart of the 10-year yield. $TNX coming down to 3.4% today, right at the 200-day moving average, which I think might be pretty important. Can it hold that 200-day moving average between now and the Fed meeting next week? Open question. Can it hold this support? Because right now it's come off of, about a week ago, we're talking about rates going to a new swing high very quickly. All of a sudden, we're back to the low from the fourth quarter of last year. 3.4% has been the floor. Can it hold? Can the 200-day moving average hold? I think that's the question for the next week. Finally, the chart of Bitcoin. Had a number of questions about cryptocurrencies, of course, with implications about what we're hearing with some of the regional banks, the failures, and what that might mean for banks, certainly with more of a indirect, if not direct exposure to cryptocurrencies and companies that are active in the crypto space. Again, I would go back to the fact when you think about the charts, there's a lot of speculation about what could happen, about what companies could be involved and what it could mean for things, but could or should is not a good investment strategy. Focusing on the trends, focusing on key levels, that makes a lot more sense to me. So I would argue right now, the Bitcoin rally that we've seen has changed the character of this chart quite a bit in the last couple of days. Do we break above 25,000 to the upside? I think that's a big, probability of a move to further highs, maybe even up to 30,000 and beyond. We are unable to hold 20,000, and that means downside risk to the November lows. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. We will be live in the studio tomorrow. We can't wait for it. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.